So I've received several comments asking me about Chinese stocks and asking me if they're safe to invest in because of the VIE corporate structure that many of them use in order to list publicly in the US. And by the way, many of these very popular Chinese stocks that use the VIE structure include companies like Alibaba, Tencent, Baidu, and even JD.com. Now, if you've never heard of VIEs or you just don't know how they work, then you're in luck because I'm going to give a very simple explanation on what VIEs are, how they work, and what some of the risks are for investing in them. Let's get started. What's up everybody, my name is Ale and welcome to my world of stocks. Now if you're new to the channel, I actually made another video just not very long ago about Chinese stocks, and I wanted to detail about the Chinese economy and why Chinese stocks are crashing right now, and if I think that it's a good opportunity to invest in Chinese stocks right now. So if you haven't seen that video, you can find a link to that up here in the description or at the end of this video on a clickable card, and I highly recommend that you watch that video as a supplement to this video if you're interested in investing in Chinese stocks right now. But without wasting any more time, VIE stands for Variable Interest Entities, and they are essentially a shell company that is used as part of a modified corporate structure that allows foreign investors to invest in Chinese companies, but that structure also takes away many rights from you as an investor. So why do we need them in the first place? Well, the reason why is because China doesn't actually allow foreign ownership of Chinese companies in several different industries. And the reason why I think is because China probably doesn't want other countries to gain access to Chinese intelligence and technology. So it is literally against Chinese law for foreigners to invest in companies that operate in some of these industries. For example, industries like mining, steel, telecom, internet, and even education. And so if any of these companies operate in any of those restricted industries, then they need to find a way around Chinese law in order to be publicly listed in international markets like, for example, the New York Stock Exchange. Not to mention that many smaller Chinese companies can't even IPO in China because the restrictions are too high. So if they're not stable enough or if they're too shady, they can't actually IPO in China. So what they'll do is, to raise public funding, they'll actually IPO in the United States because our restrictions are a lot lower. So here's where VIEs come in. A VIE is a shell company that operates somewhere internationally and usually in the Cayman Islands from what I've seen, but it acts as a sort of middleman, funneling your cash as an investor to the actual Chinese company that you want to invest in. Now, this is just a very simplified explanation so that the video isn't like an hour long, but you're sort of investing in the VIE instead of investing in the actual Chinese company. And in order for all of this to work, contracts between the VIE and the original Chinese company are drawn up, and in the contract, the VIE is usually entitled to certain assets from the original Chinese company. Now, the risk involved here is that you, as an investor, both own and do not own the original Chinese company at the same time. And the reason why is because the VIE is, again, just a shell company that is almost always run to the discretion of the original Chinese company. Their top management basically makes all the decisions, so they hold all the rights, and you as an investor have little to no rights, including voting rights. And that's a big deal because the Chinese company can basically make any decisions it wants and you can't really say anything about it. Now, say the government wants this Chinese company to hire more Chinese employees, or say it wants it to source materials domestically because these things help the Chinese economy. Well, the company can go ahead and do that. Even if you as an investor think that it's irresponsible, you can't really do anything about it. And so you might be asking, well, why would the company even do those things that the Chinese government wants them to do? Well, the reason why is because you don't want to piss off first of all, you don't want to piss off the Chinese government. But second is because the Chinese government has, at least to my knowledge, never really made VIEs either legal or illegal officially, like entirely officially. There has been some hinting towards certain things, but officially they've never really said that it's illegal or illegal. But at any moment, they can make it illegal if they want to. And if they did, or if they did that for a specific industry, or maybe they just looked at a specific company and added some regulations to that company, then that might hurt international investment. And so that company will lose international money coming in and international expertise as well. So that would hurt their growth and innovation. So the company can't really afford to piss off the Chinese government. And then you might be asking, well, why does the Chinese government neither make this illegal or legal? And I think that the reason why is because they realize that foreign investment and expertise helps these Chinese companies, helps growth and innovation, and it helps the Chinese economy. So they just kind of let it happen. But at the same time, they want to retain control. They don't want foreign ownership of Chinese companies. So by using a VIE structure, they benefit from foreign investment, but they also retain control. And at any moment, the Chinese government can make any of this illegal and retain even more control. At which point, I think that we as investors could potentially lose most, if not all, of our money. Now, some of that is speculation because we don't know exactly what would happen, but I'd have to assume that if we're investing in shell companies that are operating illegally, then there's a high chance that we could potentially lose all of our money. Now, I'm sure that a lot of investors would fight back, especially the big institutional investors. There'd probably be a lot of lawsuits and a lot of chaos, but I just don't think that the picture for us smaller investors would probably look too good. Now, one of the biggest sources that I used in this video is a great article that I was reading. I'll have it linked in the description in case you want to check it out, but it's posted on the Columbia School of Law website, and the research is from the University of Virginia's Graduate School of Business. And what the researchers did is they took a sample size of around 200 Chinese companies that are also listed, publicly in the US, and some of them are VIE structured and some of them are not VIE structured. And what they found is by using a lot of different models and methods and doing a lot of different calculations, looking at things like growth and profitability and things like that, they found that the VIE structure stocks traded at around a 30% discount in terms of their valuation versus non-VIE structured companies. So what that means is that investors know that there's a risk with VIE structured companies, so companies like Alibaba, Tencent, Baidu, things like that. They know that there's a risk there and they're not willing to pay as much money for those stocks. Now, I couldn't get exact specifics on the calculations. It didn't really list that from what I saw, but and they just kind of mentioned that they looked at a lot of different factors and used a lot of different models. But that's just crazy to me. Even if it's not as much as 30%, whatever percent it is, it just shows that investors are more hesitant to invest in VIE structured companies, and I really don't blame them. Okay, now let's transition to my personal opinion and how I feel about all of this. Now, as with any other video, this is just my opinion. You should always do your own research and make your own decisions. But if the VIE structure is something that worries you, and obviously it's worrying other investors, and it's the reason why they prefer to pay up to 30% less for the VIE stocks, then you probably shouldn't invest in those companies. If it's something that you're going to lose sleep over, there's plenty of other really good stocks out there, plenty of other really good value out there in the stock market. You don't have to buy Chinese stocks if you're not comfortable investing in them. However, I personally, and this is just my opinion again, I don't really think that the Chinese government is going to make VIEs illegal. And there's two main reasons why I think that. One is because it would hurt their Chinese companies. If you all of a sudden cut foreign investments and foreign expertise, that's going to dramatically hurt these Chinese companies' growth and innovation. And that's something that China cannot afford to receive right now, because the Chinese economy is slowing down and the Chinese stock market is essentially crashing. In fact, their GDP annual growth rate has been in a downward trend for close to a decade. And just this year alone, it dropped from around 6.8% in Q1 down to 6.5% in Q3, even missing already lowered estimates of 6.6%. And then looking at their stock market, they're essentially in a bear market, with the Shanghai Composite Index down over 20% year to date and down well over 25% from their 52-week high at the time of this recording. And many of those Chinese stocks that are listed in US exchanges are down massively from their 52-week highs, including Alibaba down over 30%, Tencent down over 40%, and JD.com down over 50%. So restricting foreign investment in these Chinese companies does not sound like a good idea to me. But perhaps an even bigger reason why I don't think they would do this is because it would make China look so incredibly bad on a global scale. And look, I get it. Many people say that China already does a bunch of shady stuff and they don't really care what people think and they just keep doing it. But this would be on another level in my opinion. I mean, if you cut VIEs, think about how many people could potentially lose all of their money that is invested, the foreign investors investing in these Chinese companies could potentially lose all of their money. I just think there's no way that China gets away with that. I could be wrong. Maybe they do it and maybe they do get away with it, but it just seems so unlikely to me. And it would just bring so much negative attention to China. And on top of already all the negative attention they get, I just think that China cannot afford to receive more negative attention on the global scale than it's already receiving. So all in all, I think that VIEs are a very real concern that every investor should be aware of, but it's not something that's going to prevent me from investing in Chinese stocks. Now, what a lot of these companies do is their VIE managers will actually try very hard to attract foreign institutional investors, so very big institutional investors, because if there are some really big institutional investors, there's a lot of money tied up there. So the stocks will have a lot more popularity, they'll gain a lot more attention. And so then it's less likely that the Chinese government is going to go and say, hey, these VIEs are illegal and, and screw over all of these huge institutional investors that have a lot of money. You know that they're going to fight it and it's going to be a huge mess. So what they do is they try to attract those institutional investors because they know that it'll make other investors feel more confident and safe about investing in that company. Another thing that they will do is a lot of times they will appoint directors that are closely connected to the Chinese government. And the reason why is, again, because if they have directors that have a great relationship with the Chinese government or even work for the government or anything like that, it's less likely that the government will come out and say, hey, your VIE structure is illegal, and just screw over the company and all of these investors. So those are things that I generally look for. If I'm thinking about investing in a Chinese stock, then I'll try to research their VIE structure as much as I can. I'll try to find as much information that is available. And then I'll also look for big institutional investors that are investing in that company. And I will also look for a lot of public awareness. So if it has those things, then it does make me feel a little bit safer about my investment in that Chinese company. So anyway, I think that just about wraps it up. I hope you enjoyed the video. If you have any questions, leave them down below. Again, this is all just my opinion. I try to condense everything and simplify it, so I apologize if I left anything out. Please make sure that you do your own research. And then just a quick disclaimer, I own NEO stock, which is a Chinese stock. I'm thinking about jumping into Alibaba soon. So anyway, just in case you were wondering, but yeah, I'm not planning on avoiding Chinese stocks. I do plan on investing in them. I think there's a lot of opportunities in Chinese stocks, but I know a lot of you really disagree with that. I've received some comments. A lot of you are very, very anti-Chinese stocks, and that's totally fine. We can all have different opinions and talk about it. Anyway, please hit the like button if you enjoyed this video. It really helps the channel survive and grow, and I hope you all have a wonderful day. Stay safe out there. I know it's a volatile market. I'll catch you guys later. Bye-bye.